Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Julie Hyman this morning. Let's get to the three things that you need to know today.
First up, U.S. stock futures rising this morning as the U.S. and the EU agree to fast-track trade talks. Last week, President Trump threatened to impose a 50% tariff on the EU starting June 1st after complaining the bloc was slow-walking negotiations and unfairly targeting U.S. companies. But Trump extended the deadline back to July after a call over the weekend with EU Commission President Ursula von der Leyen.
Plus, Nvidia shares pushing higher today ahead of its hotly anticipated earnings results. They're due out after the closing bell Wednesday. The chipmakers report will show that it remains on track to top estimates for the year. Here, ultimately, Nvidia remains the leader in AI computing right now, but investors are going to be looking for updates from CEO Jensen Huang on the company's sales outlook, its competitive edge, and how it's navigating geopolitical tensions that could cut the company off from some major markets. Yahoo Finance will bring you full coverage of Nvidia's earnings results this week. You do not want to miss it.
And Tesla seeing its sales plunge in Europe, dropping 49% year over year. Tesla's European sales have now fallen for a fourth straight month as a backlash against CEO Elon Musk's political views, combined with a tepid reaction for the new Model Y and heightened competition, weigh on the automaker. Half an hour until the opening bell on Wall Street. Let's get a check on the markets right now. First, we check on stock futures, where we are seeing some strength here. And this following the news over the weekend that after the threatened 50% tariff on the EU was set to take effect June 1st, over the weekend, President Trump spoke to EU Commission President Ursula von der Leyen. They came to some sort of agreement to push the tariffs back until July 9th, as they continue to negotiate. Stock futures rebounding this morning. We also want to take a look at what's going on in the bond market, because remember, we have been seeing yields push higher, that both reflecting the concern about what's going on with the U.S. tax bill, as well as some global cross currents. But today we are seeing some relief on the bond front. And part of that has to do with what's going on in Japan, because we're watching some signals from Japan's finance ministry that it might start to taper off issuance of bonds there. Now, why is that important? Just like here in the U.S., Japan has seen its bond yields spiking. That means that the cost for the government to borrow is going higher. And so if they are taking a measure like that, could we see other central banks take measures like that? Some analysts are saying this could be just a temporary move, but something to continue to watch, because it does create a bit of a global ripple effect. And then finally, on that note, let's also check on the U.S. dollar here this morning. There, too, we are seeing a little bit of a movement higher versus a basket of currencies. And again, people watching what's going on in Japan closely.
Well, stocks moving to the upside this morning after the EU agreed to accelerate trade talks with the U.S. after President Trump threatened to impose a 50% tariff on the bloc's exports, which the administration says would take effect on July 9th. Joining us now on these and more, we've got Ed Mills, Raymond James, Managing Director. Ed, good to speak with you. Good to grab some time here. Coming out of a weekend where we've kind of essentially just had the trade talks on the front end of it and now on the back end of it once again. I mean, at this point, we're kind of picking petals from a flower, trying to figure out if we're any closer to a deal. How are you looking at this, and ultimately what the pillars of a good deal would look like over the course of these talks?
Yeah, Brad, the roller coaster continues here. What we've told clients at Raymond James is that expect this roller coaster to happen. Expect that we're going to get posts and announcements from President Trump that he's going to double down. Expect those to be walked back. But one thing that's really important here, Brad, is that President Trump is really good at resetting the goalpost. And so while we have a delay in this June 1st deadline of 50% for the EU, now that's going into July. But is the baseline higher than 10%? And that's what we should be asking ourselves. It looks like globally, most of the world will be at 10%. The EU was set at 20% on Liberation Day. Is it going to be at 20% come July 9th? Is it going to be structurally higher? You asked what a good deal looks like, Brad. I think for this next couple of weeks, next couple of months, what the trade representative of the United States wants to do is rack up a lot of MOUs, getting a number from these countries of what they're willing to purchase from the United States, what they're willing to give for market access. Because I think what Donald Trump really wants here, Brad, is the ability to say, I got a deal with 100 plus countries representing Y trillions of dollars of purchases and X trillions of dollars of market access. All of the details to be worked on later this year and into 2026.
So 2 questions for you, Ed. First of all, I want to start with what you're just talking about here, the length of time it's going to take to work out the details from all these memoranda of understandings, the MOUs you referred to. What then is the market risk as those details are being worked out? Because the market is reacting to the plan to make a plan, right? How important will those details be as we get them, and what's the potential for them to either provide positive or negative catalysts for stocks?
Yeah, so Julie, when I was in New York last week meeting with clients, what I heard time and time again is that we are past peak tariff concerns, that we have the kinder, gentler Trump. And what I was concerned about is I was telling clients, look, we're a tweet away from the tariffs to go up on EU because those negotiations weren't going well. And that's exactly what we got. So I think the market, if they can get assurances that it does not seem as if these tariffs are going to snap back on, then the market can continue to do well. But if there's a sense that they're going to snap back in our expectations that these deals are going to prolong uncertainty, that's when the market gets concerned. On April 2nd, almost every client I talked to was thinking about that as a clearing event, and then it was much worse than expected. And so my concern from the conversations I had at Raymond James last week was how much people are positioned, once again, for nothing to happen. When we're all on one side, that's when this market gets offsides.
The other thing I wanted to ask you about is Paul Krugman's column this morning, where he basically says that Europe should throw its weight around in these negotiations, that it is in a stronger negotiating position than it perhaps realizes. But do you see that happening? Do you see the EU kind of standing firm on this?
Well, I can tell you for one thing, the Trump administration is not going to follow the advice of Paul Krugman. And
Shocker.
The reality is that what we have seen is that when you retaliate against Donald Trump, he doubles down, triples down, moves the goalposts. You look at what happened with China. China responded with reciprocal tariffs, and he went to 145%. Now, that was unsustainable, and they've walked off.
Well, I was going to say, but then he backed off in return for, in other words, you're saying like he's coming, he's sort of then ratchets up the ante, but in every other situation, he's then ratcheted down pretty quickly.
Yeah, Julie, what I would look for is, are there pressure points? Are there things that the EU has that we absolutely need? When I look at the China example, I think the number one reason why we backed off was because China put a export restriction on rare earth minerals that we only had a 6-month supply of. And after that, our industrial capacity in this country was essentially going to be exceptionally limited on the ability to make cars, airplanes, defense equipment. So to the extent that you have something that the United States absolutely needs, then you can get aggressive. However, if you don't have that, the Trump administration is going to push the U.S. advantage. Now, I don't think that the administration necessarily wants an ongoing trade war, but they do want the EU to buy more liquid natural gas from the United States. They want the EU and NATO members to get up to their 2% of NATO funding that's guaranteed under the NATO agreement. I think that we want to have critical mineral and rare earth mineral agreements. And I do think that we want the EU to purchase a lot more Boeing airplanes, Nvidia chips, AMD chips, other purchases. To the extent that you can offer that up to President Trump, he's willing to cut a deal. If you get aggressive, the unintended consequences, I think, are quite high. And that's where I get concerned. And I don't necessarily think that's a best negotiating strategy from where I sit here at Raymond James.
And just lastly, while we have you here, we're keeping close tabs on a bill, a big, beautiful bill, as Trump has called it previously, and hopes that it will get passed. But it sounds like it could be dead on arrival when it gets to the Senate and in some of the negotiations that are taking place with some of the cuts that even on the GOP side, they're looking to implement. What's your assessment?
So my assessment was May was for the House of Representatives, June is for the Senate, July is to work out the differences, and August is to get this to President Trump's desk. When we look at this bill, there are two alternatives to getting this done. Alternative number one, we default on our debt. We're not going to do that. And alternative number two, at the end of this year, the 2017 tax changes expire for individuals. That would be the highest tax increase in the history of this country. Republicans are not going to let that happen. My view about what passed the House is it's about 80 to 90% there. That 10 to 20% that the Senate's going to change are hugely consequential. What are the cuts to Medicaid, Social Security, or actually SNAP benefits, education benefits? What are the changes to the Inflation Reduction Act? Are they going to extend out the corporate provisions? Are they going to change the no tax on tips or no tax on Social Security over time? Those are all up for negotiations, but I do see this still getting to the president's desk by the beginning of the August recess because we have to lift the debt limit. And what I always remind folks is that this is the most expensive bill by dollar amount in the history of the United States. Obviously, it's going to have some speed bumps. Obviously, it's going to have some hurdles. Most bills die 3 times before they get signed into the law. I'm sure that's going to happen here, but I don't really see a scenario where they don't get something to President Trump's desk.
Yeah, we'll see if the most expensive also means the most productive over an extended period of time as well. Ed, thanks so much for taking the time here with us this morning.
Thank you.
Nvidia results due out Wednesday. They're going to offer some of the latest read on demand for semiconductors and the AI trade on Wall Street. But is Nvidia the only name in the game, or is competition heating up? Joining us now, we've got Paul Meeks, CIO for Harvest Portfolio Management, and John Vinh, equity research analyst for KeyBank Capital Markets, who has an overweight rating on Nvidia and a $190 price target. Great to have both of you here with us. John, I just want to start with you. Can Nvidia maintain its lead against rival chip makers?
Yes, in the near to medium term, absolutely. They are ramping a new architecture called Blackwell GB200 and NVL72. Obviously there's some supply constraints related to the ramp, but it's a hardware plus GPU chip-based solution that also integrates the GPU into the CPU, which gives them a significant performance advantage over the competition. The competition does have a roadmap that is expected to follow suit, but they're at least a year behind at this point.
And Paul, I want to get you to weigh in on this too. Do you think that Nvidia retains its dominance, and if so, for what period of time?
I think that they will, and I agree that the manufacturing lead is at least a year, maybe longer. But as I think about what this company is going to say on Wednesday, I must say, particularly with the rebound that the stock has had all the way back to 134, with the all-time high being 150-ish, I'm a little bit worried that although they will most likely not just meet, but beat slightly, will that be enough to appease Wall Street? And remember, part of the thesis here was their revenues were going to rapidly reaccelerate in the second half of this year. With all the geopolitical turbulence, I don't know if that's the case. And so what I do is I hold my stock. It's still my biggest position, but I am a little bit anxious going into this report.
Just to follow on that, Paul, what would you need to see from a chip that actually appeals and appeases some of the requirements now in place, especially as Nvidia is planning for this China-specific AI chip that might be a little cheaper?
So I'm glad that they have that chip, because if it is allowed to pass through the censors, i.e. the regulators, then that's a good thing. It's better to have some revenue at whatever gross margin versus none. But I need to see the company guide to revenue acceleration, and also, are we at the trough of the gross margin hit? They took a gross margin hit due to ramping up manufacturing. All semiconductor companies do that. But I'm now thinking that the hit to gross margins might be pushed another quarter out. These are all transitory issues. They are not long-term or secular issues. So I still like it long-term, but those are some of my near-term concerns, Brad.
And John, I want to get you to weigh in as well on this idea that Nvidia is developing some kind of alternative that it will be able to sell in China. Do you think we'll get news about that more specifically tomorrow? And if so, how much revenue do you think they can recoup?
Yeah, I think we'll get some color on the call. Obviously, it's going to be a key focus on the call in terms of what's happening within China. So we do think that they are working on another China-compliant chip. This new chip does not use high bandwidth memory, so there should not be any sort of regulatory issues with it. I mean, this chip is effectively similar to a workstation chip. The issue is it's not going to fully make them whole and backfill. If you look at the $5.5 billion write-off, it roughly translates into a $12 billion headwind. We think with the lower ASPs on this new chip, they can probably backfill 8 of that 12 billion at this point.
And so, as you're thinking going forward here, the most investable AI play is it still Nvidia, or and I ask that specifically, John, thinking about how far we've run thus far, or is there another semiconductor play that has larger upside potential at this point, even though Nvidia has been the poster child?
Yeah, I don't think it's an either or decision at this point, but our favorite AI plays right now are going to be Nvidia and Broadcom, right? Thematically, if you think about Nvidia, they're clearly the leader on the merchant AI chip side. Broadcom is the leader on the custom AI silicon side, right? Obviously, their big customer there is Google with the TPU franchise, and at this point, you're seeing both types of chips get significant amount of capex spend devoted behind them in terms of spendings, and they're clearly the two leaders in the space at this point.
Paul, I think John brings up an interesting point, which is that it's not necessarily zero sum, right? Even though Nvidia has been very dominant, how much room is there for other players to also do very well, and more to the point, to be a good buy right now?
Well, I think there's a lot of room for players to be great, but the problem is, can you execute to close that, what I think is about 1.5 year manufacturing gap? And so the demand will be there. The demand will be voracious. And I do think AMD will ramp up and be a strong number 2 player. But as I start to winnow down my AI hardware and semiconductor bets, I still come to, as John said, Broadcom, Nvidia, then I would add for my big 3, Taiwan Semiconductor.
John, Paul, thank you so much. I know that you guys will be watching those numbers very closely tomorrow afternoon, as will we. Really appreciate it.
Thank you.
Great. Thanks for having us.
Coming up on Morning Brief, we count you down to the opening bell on Wall Street. Plus, Salesforce announcing an $8 billion deal for Informatica. We'll bring you the details next. And Tesla seeing yet another sales plunge in Europe. We'll break down what Elon Musk is doing to turn the business around. That's all coming up on Morning Brief.
Now time for some of today's trending tickers. We're watching Informatica and Salesforce, Trump Media, and PDD. First up, let's talk about Salesforce here, agreeing to buy Informatica for $8 billion. Salesforce paying $25 a share for the data management software firm. And the deal is expected to close in Salesforce's fiscal year 2027. Take a look at shares of Informatica jumping on this by about 5, nearly 6% right now.
Yeah, and the two had been in talks previously, back in 2024. Then they abandoned them. And interestingly, we don't know exactly why they fizzled. It might have been overpriced, but Informatica shares have since gone down. So the deal that at one point was talked about, I believe, is a $10 billion deal, is now an $8 billion deal. So interesting. But the other interesting piece of it is that Salesforce has really backed off of M&A under pressure from shareholders. And so now that they're doing this deal, which I believe is the biggest since they bought Slack, are you going to see a little friction coming from shareholders about it?
Yeah, especially given the acquire to grow strategy that a lot of the companies in the ERP, CRM, a lot of the software landscape have been known for over the years here. Now this, the latest example for Salesforce, and I had the opportunity actually to meet with some of the executives at Salesforce prior to this deal, and how they're all focusing and talking about agents right now comes back to this announcement as well here. Even Mark Benioff saying within a statement, by essentially combining these two companies, Salesforce and Informatica will create the most complete agent-ready data platform in the industry. And agent is perhaps the word that is going to be the new buzzword, if you will, throughout the software and cloud enterprise management solutions, especially with the artificial intelligence layer on top of it.
Right. One other thing to note, Salesforce reports its earnings after the close tomorrow. Ooh. It's not just Nvidia. We'll hear from Salesforce as well. And Jordan Klein over at Mizuho, he's a desk analyst over there. He said, why would they announce this deal now instead of waiting maybe a couple weeks after earnings? He found the timing a little curious, but we'll see what they have to say tomorrow. Next, we've got Trump Media announcing plans to raise capital. The company says liquid assets will jump to $3 billion as the company sells stock and convertible notes. Now, here's the important part of this. yeah, they've done a bunch of these deals to raise money already. It's what they're using the money for. They intend to use the proceeds for creation of a Bitcoin treasury, following the MicroStrategy strategy playbook in doing this, and so the shares are getting a bit of a pop on that plan.
Yeah, and we think back to what President Trump has talked about in trying to make the U.S. the crypto capital of the world, where we already are here in the U.S. We hold the most Bitcoin on a government basis. Now it's just about where you're seeing some more of the inclination to annex the name, his own name, to some of the holdings of crypto, which has been notable within DJT's strategy, dare I say. There have been so many different areas that they've kind of tried to pull on, whether that be in streaming and now whether that be in trying to create some more capital that they can throw around as a whale within the crypto landscape, And this comes after they had just held the dinner last week, and bringing together some of the crypto profiles as well. And so, again, just a further move into the crypto landscape, but it's a larger question of, okay, are they going to be holders long term of this crypto, or just try to cash in on it next time we see a big pop?
Yeah, who knows? I mean, this continues the increasing enmeshment between the Trump family and cryptocurrency. Trump himself, by the way, still owns over half of DJT, of Trump Media and Telecom. Devin Nunes is the CEO and talked about the advantages of doing this. But as you say, it does follow on the dinner last week that was for the biggest holders of the Trump meme coin. So probably not the last we'll see of these kinds of
more dinners,
business entanglements.
Yeah, exactly. Let's also talk about Temu-owned PDD missing first quarter expectations, taking a hit from trade tensions between the U.S. and China. The Chinese e-commerce company marking its slowest growth since early 2022. Taking a look at shares right now, they are down by about 17.5% on the back of this earnings. The operating profit, that was a decrease of 38% during the quarter for PDD, and shares, as you can see, reacting as they should on a miss like that.
Yeah, and the shares are down more than 30% over the past year or so. I mean, a lot of this, of course, goes back to the de minimis exemption going away. Remember, that was the rule that for small shipments into the U.S. of under $800, they would not be tariffed. Then that went away, even though there was some pause on some of the tariffs. There is some tariff on those items. So Temu has been trying to get ahead of that by shipping bigger amounts into warehouses in the U.S. and then having local merchants sell it from there. But, you know, obviously it's a quickly changing situation. So they were one of the companies that was really seen as affected by that.
I've got plenty of inventory in my closet. I'm all set.
Do you? Yeah. Maybe you should start selling it.
Maybe. Get some income.
All right, Tesla's European sales plunging in April, down for a fourth straight month. Joining us now, Yahoo Finance senior autos reporter Pras Rumanian. Pras, Tesla facing rising competition, brand damage in Europe, and these are not small declines that they are seeing.
No, not at all. You know, so EV registrations, which are a proxy for sales in Europe, fell a whopping 49% in April compared to a year ago. This is per the larger ECAA, which is the European auto body there. Meanwhile, overall EV registrations in the region rose 34.1% in April. So showing that the EV sales are still, EVs are still popular in Europe. There's just not Teslas. We're seeing gains here with Volkswagen, BMW, even China's BYD and SAIC, another Chinese automaker. So EVs, again, still popular, just not Teslas. And these results also include the effect of the new updated Model Y. It's a best-selling vehicle. It was suggested that this new vehicle would increase sales because people will be possibly waiting for that to come out. It appears that hasn't been the case. So Tesla's demand problems in Europe, like you mentioned, Julie, are real and ongoing.
And Pras, what we have you, Elon Musk says he's back to spending 24/7, 24 hours a day, 7 days a week at work. Okay, mattresses on the factory floor, I guess?
Yeah, I mean, once again, claiming his RTO, right, is real here. Over the weekend, responding to an X.com outage, Musk said, quote, "I'm back to spending 24/7 at work, sleeping in conference rooms," like he said, following this X.com outage, and that he must be super focused on XAI and Tesla, plus the Starship launch next week as we have critical technologies rolling out. So a little maybe perhaps egregious there with the sleeping at work and the conference floors, as he likes to say. But, you know, since April's Q1 earnings, where Musk has been teasing the fact that he's returning to work. And then last week with 2 interviews with CNBC and Bloomberg, again saying that he's going to be back, spending less time in Washington as his political activities sort of fade. I think he was surprised by the fact that he didn't get much done in Washington, and that he also faced a lot of deep blowback from his activities. That was sort of in a recent Atlantic article about him. So the quicker he gets back to work, sort of the better as he gets out of the political limelight. But Musk has been known as a drama seeker, right? So who knows how long that will last for him as he kind of goes back to work and stays out of that political limelight.
All right, maybe they'll start selling Tesla pillows under the lifestyle section on the Tesla shop online. Ross, thanks so much. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
There is the opening bell. It's coming. There it is this morning. So let's do a check of the markets as we embark on this holiday shortened trading week here. And, we've had sort of some rockiness in the markets last week, most notably on Friday, when it seemed as though President Trump was threatening the EU with 50% tariffs to take effect on June 1st. Now those have been pushed back to July 9th. So we've been seeing a relief rally in the futures this morning. And of course, investors are also looking ahead to Nvidia earnings after the close tomorrow. We're going to be talking a lot about that, not just today, but all this week. So ahead of all of that, we are seeing the Dow up about 350 points to out of the gate this morning, up about 0.9%. The S&P 500 up about 1.2%, and the Nasdaq is bouncing by about 1.5%. As we've been talking about, we've also been watching the action in the bond market, where we are seeing a little bit of relief on yields. Remember, of course, there's been a lot of concern over government spending tied to this new tax bill, and we've been seeing yields creep up, which then has created a bit of a negative feedback loop for stocks, but a little bit of relief on that front as well this morning. Looking at the sectors in the S&P 500 today, at least initially, everything in the green being led by tech, the XLK, and the XLY, which is consumer discretionary, and then flipping on over to the NASDAQ 100. A lot of green here, with the exception of PDD, which we just spoke about, the owner of Temu, down 17% on some earnings disappointments there. But we talked about Nvidia, of course, looking ahead to that tomorrow. Those shares up a little better than 2% as we head into the earnings here. And just wanted to take a quick look at a year to date for Nvidia. Very little changed on the year. A lot of concerns for Nvidia about some of the export controls, the effect on the company, and then just about momentum. So we'll hear what the company has to say when it comes out with its numbers tomorrow. Brad?
Thanks so much. It is time now for today's strategy session. U.S. stocks rebounding from their latest trade-induced sell-off, but the market action was relatively muted compared to the Liberation Day meltdown. So are investors now focusing more on the fundamentals at play versus headlines from Washington? Joining us now, we've got Rob Hayworth, who is the U.S. Bank Wealth Management Senior Investment Strategist. Rob, good to have you here with us. Let's just start with that question alone and how markets are attempting to kind of shrug off what the front end tends to entail, which is the panic selling for a hot second and then the relief that it's not as bad as it could be.
Yeah, no, it's a great point. I think the market is really still trying to understand the magnitude of tariffs and what that implies for inflation and growth, and then also therefore for earnings. What are companies really going to have to deal with? What is the structure here? And the market has been guessing the whole time. We think we're still kind of in this range-bound market until we can really understand where tariffs settle out. Our base case would be we settle out at a weighted average tariff rate of 10 to 20%. There could be good news that could really help drive the market higher if we can settle out 10% or less. But there could be challenges if we're settling out at a weighted average tariff rate north of 20%. That certainly last week was the concern as we talked about tariffs arriving quickly on the European Union. Fortunately, those have been delayed now to July 9th, which is when we have the expiration of the 90-day hold on everyone else. And so the market is seeing some cheer for that. But I think the struggle for companies is still, what environment are they facing, and what does that mean for full year earnings and earnings into 2026, which are so important to drive this market higher?
And Rob, when it comes to market reaction to all of this, is there sort of a diminishing effect at all from tariff headlines? Because after all, we didn't see that huge of a reaction actually on Friday to this 50% EU tariff threat, but we are seeing a fairly significant reaction, at least out of the gate here this morning. I mean, I guess my question would be, how seriously are market participants taking the various headlines at this point when they seem to, in this case, very quickly get ratcheted back?
Yeah, I think there is still some seriousness here, but it looks like the worst case scenario, which is what we were really pricing in at the April 8th lows around 4,800 on the S&P, is off the table because we've delayed tariffs with China, which was the biggest rate. We're delaying again. So the market is maybe not as concerned about the worst case scenario. But I think you're right. We're kind of oscillating around a center here where the best case scenarios aren't in play either, right? It really looks like the president wants to hold tight to 10% minimum tariffs across the board. We'll have to see how that plays out. The market is really trying to hone in on this, but I think the challenge is, as we look ahead to wrapping up first quarter earnings, as you point out, and head into second quarter, will companies finally have a clear understanding of the cost structure they're facing to really start to bring back some of that guidance for the rest of the year and into the next year?
And so with this level of tariff rates internationally, until we essentially see some of these deals start to come through, what is the risk appetite that investors can feel comfortable taking on, and where within the market?
Yeah, it's a great, I think it makes it a challenge to really head all in terms of risk assets. So we're taking a more neutral approach and looking for more diversification. I know that's a common refrain in this industry, but as we think about it, we think we're finally getting paid to have some diversification, whether it's in equities looking this year to be more globally oriented because we think the tariffs are a little more challenging for US than they are for the rest of the world. And so we've seen good performance for foreign stocks, whether it's developed markets, Europe, Japan, emerging markets. We've seen kind of better performance there so far this year than we have in the U.S., partly because of a weaker U.S. dollar. So equities, we'd look there. But even within the U.S. S&P 500, we'd look to get more diversification across sectors. And then we'd look hard at fixed income. You're getting paid the highest interest rates in more than 10 years. And we'd look at some of the more esoteric sectors like structured credit, reinsurance, to capture those mid to high single digit incomes in what looks like a decent economic environment for now.
And Rob, on the fixed income side, do you expect rates to go higher from here? They're pulling back a little bit today. That's because there's some speculation that Japan might ease off on issuance. Do you think we've seen the highs for, say, the 30-year in this cycle, or do you think there's more room for it to go up?
Yeah, we don't spend a lot of time projecting that, but we do think that in price there is truth, and we'd be a little concerned or a lot concerned if the 10-year Treasury started to break above 5%. That would tell us there's really a challenge in the market with deficit spending and the U.S. debt. On the lower end, we'd say there's probably a growth scare if we're getting back to 4% and lower on the 10-year Treasury. So what we're seeing really is a wide trading range in high quality fixed income, which is why we're looking to go out in terms of certain credits to capture extra yield, because we think we're kind of locked in here until we have some clarity on the environment ahead, which is either deficits are a problem or there's a real growth challenge for this economy that the Fed's going to have to address on the low side for those 10-year treasuries.
Gotcha. And that's a good way to frame it, I think, for people to think about it in terms of what those yields signal. Thanks so much, Rob. Good to talk to you.
Thank you. Great to talk to you.
Let's get to the three market movers you need to watch for the trading day. Yahoo Finance's Jared Blickery is here with that. Hi, Jared.
Thank you, Julie. A lot's happened in these last 3 days. So I'm going to talk about stocks first, then we're going to get into yields, and then we'll get into gold, both the digital and the physical kind. So let's dial up the Wi-Fi interactive here. I want to start with the All-Country World Index by MSCI. This is a year-to-date chart. 1 year ago, we had just punched through to all-time highs, barely, but it was one and done, because after that, we came down a little bit. The Dow had 4 straight down days. The S&P 500 did too. But what you're going to notice here, this is just a little flag, a little blip here, and that's what we call a bull flag. And this is going to be a reoccurring pattern. I'm going to show you in some other markets in a minute. First, I want to get to the S&P 500. This has come down. Now, there's an important level which has acted as support and resistance before. If you were to look at the intraday and candlesticks, hard to see here, it actually touched this. And so it is bouncing off prior resistance. That means that these levels are intact. Also happens to be the 200-day moving average. So that is intact as well. Everything's pointing towards the possibility of a more bullish resolution, notwithstanding the weakness that we saw last week. I want to show you what's going on with the VIX. It popped up. Let me show you the 5-day. It popped up last Friday, but it came down, just hovering above the 20 level. Want to see it maybe a little bit lower, but that's a definite improvement from Friday, middle of the day. Now here's tech. I'm going to dial this back to a year-to-date chart. I'm going to show you a bunch of charts with flags here, bull flags. So that's tech. Here's the Mag 7 ETF, MAGS, boom, Nvidia. There you go, very similar. That's going to be in forefront of investors' minds over the next couple of days. And then finally, here's the ARK Innovation Fund. So it's not just large cap, it's also small tech as well in the disruption field. So broad-based strength in the tech sector, I think, is pretty good here. Got to talk about auctions. 30-year yield finally dipped below 5%. That was a risk-off event last week, but we've got 2-year, 5-year, 7-year bonds on deck in total amount of $211 billion. The big auctions are in 2 weeks, but there's going to be a lot of focus on here because we had not a failed auction, but a bad auction here in the US last week and in Japan as well. And because of that, we're seeing Japan potentially take some measures to, reduce their debt size, and that is giving the US dollar a little bit of a bullish tilt here. That is up here, but it is still hovering near 3-year lows. That's something we want to take into consideration too. And with just a little time left, I'm going to show you what's going on in gold. Let me get to the 5-day. You can see we are down a little bit. So gold is having its biggest slide in about 2 weeks here on the daily chart. But guess what? Digital gold still holding 110,000, not quite up to those record highs, but it did punch through to record highs last week and looks pretty bullish in its formation. So we'll see if the leader in risk markets, Bitcoin, can lead again this week. Back to you guys.
Jared, great setup. Thanks so much. Appreciate it. Coming up, ahead of earnings from Macy's, why retailers may want to prepare for a consumer spending slowdown. That's on the other side.
Macy's is set to report along with several other retailers this week. It comes in the midst of an earnings season that has seen some names, including Walmart, say that tariffs could boost prices. Joining us now to give a read on the sector, Deborah Weinswig, CoreState Research founder and CEO. Deborah, it's good to see you. So let's talk big picture, first of all, right? Because there are certainly, seemingly from consumer surveys, consumers are nervous right now. How is that translating into spending at these retailers?
First, thanks for having me, and it's a great question. So we have done a weekly survey of consumers since January of 2020, and we have seen in the past week actually a dip in consumer sentiment kind of across the board, household income, geography, et cetera, not only about their own finances, but about the bigger picture. And so obviously that leads one to be concerned as we go into the summer shopping season. Back to school and holiday are the two most major shopping occasions in the few months ahead. And so I would say that consumers seem a bit more jittery. I think there's concerns about summer travel and tourism, and that is definitely leading to, I would say some pullback in enthusiasm or consumer confidence.
Has the rise in digital-first apparel brands been the biggest, perhaps not the biggest, but a major headwind for the digital transformation that Macy's itself has been trying to make? And what's the net impact of that?
So if we think about, we'll call them ankle biters. So a lot of these, probably companies most people have never heard of, but a lot of it is also these micro trends. So whether it's social media or whatnot, there are trends, right? They're here for kind of 4 to 6 weeks. And it can be very difficult to lean into those. You may even have the inventory in your warehouse, but to kind of reposition the sales floor, move quickly, that can be difficult. So when we're talking to a lot of more of the department stores and specialty retail, those are some of the challenges that we're seeing.
And so, Deborah, let's get specific now. Let's talk about Macy's for a moment. I'm looking at the stock, which is down about 40% over the past year. What needs to go right for Macy's? What do we need to hear from them?
I mean, number one is traffic, right? You've got to see the traffic. Number two, I would say, is conversions. So once the consumer's in there, are they finding their size? Are they finding their color? Are they getting assistance? So conversion. And then number three, I think it goes back, some of the really interesting conversations with leadership there is that ultimately the product is probably about the same price as you would get at an off-price retailer like a TJ Maxx or Ross Stores or Burlington Coat Factory. But the issue is it's a coupon, it's a credit card. The pricing tends to be a bit less transparent for the consumer. And so I do think that does hurt them in the near and long term unless they can figure that out.
Is this a long-term activist target? We were talking about this during the break, trying to figure out and recall exactly where Macy's really stood within some of those historical battles that it's had to navigate through.
I mean, you've seen, right, the department stores have definitely been a target. And I think it goes back to, at a high level, when you think about some of the things that could be fixed, you have, I would say, broken, damaged relationships between the vendors and the retailer. That's something that, is an opportunity. Secondly, on the positive side, private label has gone very well for Macy's. So I do think you have this hidden gem. And, going back to how do you kind of market that? How do you target that to new consumers? And then number three is just, they're spending so much, whether it's, kind of CapEx or OpEx on, as you alluded to, digital transformation, but are they spending it in the right places? And then also, how are they communicating that to Wall Street? I think that's been a challenge for a long time, and I haven't really seen that improve. And I think that's their kryptonite, if you will.
And then, Deborah, contrast that with some of the specialty retailers that we're going to hear from this week. We've got Gap, we've got some of what we used to think of as the teen retailers, although I guess they've expanded out now. Have they been largely sort of performing better than department stores, or is that overgeneralizing?
No, I would say that I think that's right. They've got a very clear point of view. They do a great job of leaning into these micro trends. I think their marketing is kind of more current. And, they've also done a great job of being in stock, right? There's been with consumers changing sizes, unlike anything we've seen really kind of in the past 18, 24 months, the specialty retailers have done a much better job of being in stock on the right size. So it's been kind of size, it's been these micro trends. And I think that the overall environment has really been in their favor. And one thing that's interesting to know is as we move into Gen Z being a greater portion of the shopping base, that consumer is stores first, right? Or we could call it unified commerce, but stores play a critical role in terms of like about 70% of transactions versus about 50% for millennials. And so the specialty retailers tend to offer a better in-store experience, which I think we're really starting to see show up in the numbers.
Deborah, we only got 15 seconds here. Best positioned retailer to outlast some of the tariff threats that continue to be a consideration, obviously, on an inventory front for them?
I mean, for me, it's TJ Maxx, right? They do an amazing job of communicating value, being in stock, and really being relevant to the consumer.
Deborah, good to see you. Thanks so much for taking the time here a little bit after the open.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. Investors are digesting new comments from the Fed amid further uncertainty around President Trump's tariff policies. Here with more, we've got Yahoo Finance Fed correspondent Jennifer Schonberger. Hey, Jennifer.
Good morning, Brad. Minneapolis Fed President Neil Kashkari calling for holding rates steady this morning as he awaits the impact of higher tariffs on inflation and to guard against longer-term inflation expectations from heading higher. In a speech in Tokyo this morning, Kashkari warned against looking through the inflationary impact of new tariffs. As he noted, there is a healthy debate within the Fed right now about whether the impact on inflation from tariffs will prove longer lasting. Kashkari made the argument it may take months or years for trade negotiations to conclude, warning there could be tit-for-tat tariff increases. He also stressed that some tariffs apply to parts used to make final products and that it's going to take time for full effects of those price increases to pass through to final prices. Now, this week, we will also hear from Fed Governor Adriana Kugler, as well as Richmond Fed President Tom Barkin, Chicago's Austin Goolsbee, and San Francisco's Mary Daly. We will also get the Fed minutes out on Wednesday. So a very busy week of Fed speak. Guys.
Yeah, and in addition to the Fed minutes, there's a lot of data out this week for the Fed to decipher as well. So what are they going to be prioritizing here, Jen?
Yeah, that's right, Julie. The Fed is going to be getting a fresh reading on their preferred inflation gauge, that core personal consumption expenditures index. That will be for the month of April. And guys, recall in April, that's when we really saw the tariffs kick in full blast. The president announcing those reciprocal tariffs on April 2nd, only to pause them for 90 days. However, he retained that 10% blanketed tariff on all goods coming into the U.S., so that will be in full force, along with the steel and aluminum tariffs. And he retained tariffs on China, even ratcheting them up, recall, 145%. And still, even with all of that, economists expect core PCE to actually drop 0.1% to 2.5% from 2.6% in March. So we'll see how that data actually shakes out. We're also going to get a second reading on first quarter GDP, which surprisingly contracted by 0.3 percentage point. Economists still expecting a slight contraction, though, in that second reading. And we will also be getting some fresh readings on consumer sentiment, the first of which coming out in just the next couple of minutes.
All right. Jennifer, thanks so much.
Thanks.
That does it for the morning brief, everyone. You can join Julie in the next hour for more analysis on Catalyst, myself at 11 a.m. Eastern Time for Wealth. We'll see you in a second.